Hi Gaurav, can you hear me now?
Hey, yeah, I can hear you. Hi,
Yeah,
good
sorry, yeah.
afternoon. How's it going?
Good, good. How are you?
I'm good, thanks. Just waiting for the others to join.
Yes, yes, we're just waiting for the others and then, yeah. Hi Chai.
Hi Rashmi, how are you?
Good, good. How are
Hi.
you?
Good, good. We're
Hey,
really.
The
Chai,
week.
Hey Gaurav, how are you?
should we kick off?
Yeah.
Maybe just wait for 2 minutes while
Yeah,
everyone.
we'll just wait.
Yes.
Zach and Max, they're not joining, is it?
I think they are. They open up to questions as well. Let me share my screen just to check. Perfect. We're getting very good at this now.
Thanks, Rashmi.
Yeah, no worries. Yeah.
Let's.
We'll just wait for another minute and then can we start?
Yeah, absolutely.
Chai, if you don't mind, I just, I mean, can you share the screen after we just share the presentation? Is that okay?
Sorry, I don't
Since we are
understand.
live streaming, we'll be sharing a presentation. Once we finish the presentation, then can you share the screen?
Once I finish the presentation, then share the screen. Oh, sorry, do you want me to not share the screen?
Yeah, not right now, just after like 2 minutes.
Oh,
Yeah.
oh okay, sorry. Stop
Sorry about
share.
that. Hi, Max.
There we go.
Sorry, you're on mute.
Hello, everyone. Hello, Rashmi. Hello.
Hello.
How's everyone going?
Pretty good.
Been good.
Good. Very good.
Okay. So I'll just wait till they share the presentation, then we can start. Yeah.
Yep.
Vijay won't be joining today, so it's just
Yep.
Absolutely. Actually, go.
So welcome everyone for the weekly Banyan Tree and Laverne meeting. We will be live streaming this today. Today we're just doing one thing different, is that today you can mute and unmute yourself. So that is, I mean, you don't have to, I don't have to keep muting you. And today's discussion is on the macro update, and I guess Chai is going to start presenting now. Chai, you can share the screen right now.
Sure. Thank you, Rajmi. Today, the topic will be on just a monthly wrap of last month, presented by Gaurav Singla, followed by a macro update presentation by myself. As you know, Gaurav is one of our investment managers on the team. He's been doing it. He has a background with a degree in accounting and a master's in finance, and he looks after the international portfolios for our firm. Let me just share my screen so that I can help him with the logistics of doing the presentation work. but over to you, Gaurav.
Thanks, Shai. Good afternoon, guys. Just in case the internet plays up and I get my screen gets frozen or my voice cracks in the middle, just let me know so I could just repeat. So okay, I'll start with the monthly wrap up for August. So August been a really good month for the markets. Starting with the U.S. markets, the markets were stronger, both up with the Dow Jones up about 1%, S&P up about 3%, primarily because of the sentiment boosted when FDA provided a full approval for the vaccine made by Pfizer and biotech, and also because the Federal Reserve signaled that the chair signaled that they reassured the market that the increases in the interest rates won't be rushed despite the economy starting to recover from the pandemic. Also, the US economic growth came out to be really good in the second quarter, with the second quarter GDP revised slightly higher from their initial estimates, with the GDP increasing at about 6.6% annualized, compared with initial reported of 6.5%, which reflected stronger business investments and exports than previously estimated. The European markets were higher during the month. The European GDP was also revised higher. The euro area economy expanded faster than previously reported in second quarter. The GDP increasing about 2.2% quarter over quarter, more than 2% quarter over quarter initially reported, primarily driven by a surge in consumer spending, which saw the households' consumption increase about 3.7% quarter over quarter. The Asian markets did pretty well, despite China's crackdown on a number of its industries, and China pushing towards the Common Prosperity Program, with the sentiment primarily driven because the central bank came out. They reassured the markets to support that they will be supporting the economy with appropriate money growth. And they also announced to provide about 300 billion yuan of low-cost funding to banks so they can lend to small and medium-sized companies, and pledged better use of local government bonds as the economy slowed down further, showed further signs of slowing down because of new lockdowns because of the virus outbreaks. The only market in Asia which was down was South Korea, not down too much, probably flat month over month, with primarily because of the inflation concerns, which with data also revealing that the inflation in South Korea ran faster than expected in August and held above the central bank's target for a fifth month, with CPI increasing 2.6% year over year. And also the sentiment was a little bit hit because investors were concerned that South Korea would start rolling back its stimulus measures, which also following central bank's decision to raise interest rates by 25 basis points to 0.25%, and also indicating that more hikes remain in the pipeline as financial risk pose a bigger threat to the economy than the latest virus outbreaks. The commodities, WTI oil declined about 6.5% in the month to about $68 after OPEC Plus agreed to ease the production cuts by 400,000 barrels per day every month beginning in August. And IEA came out cutting forecast for the global oil demand for sharply for this year, but predicted a new surplus in 2022. The decision, though the oil in recent days has been down, primarily due to impact of Hurricane Ida on the U.S. Gulf, with the storm taking nearly 95% of the region's oil production and refining offline. Iron ore prices were down. Gold remained primarily stable. In terms of political news, Taliban took over Afghanistan, which has been they taking out strikes on the Kabul airport, and which saw US retaliate and doing drone strikes on militants. And Japan's prime minister announced his decision to not run for re-elections, signaling the end of his tenure, which has put a positive sentiment towards the stock in Japan, primarily the telecommunication stocks, as the current prime minister was pushing towards bringing down the mobile plan rates. So it's been positive for a number of industries. So in terms of economic news, the U.S. hiring was quite low. Came out to be pretty low in August, with the smallest jobs gain in 7 months. Though the unemployment rate fell about 20 basis points month over month to 5.2%, though the manufacturing in the US remained pretty strong, with like reflecting fast orders and production growth, as well as rising backlogs. And though the consumer confidence dropped in August to a 6-month low because of the concerns of Delta variant and elevated prices, the inflation, which has been weighing on the view of the economy. The US home prices were pretty strong in the last quarter, with median price of an existing single-family home jumping about 23% year over year due to scarcity of listings. China's economy took a hit in August because of the Delta variant outbreaks. PMI data revealed service industry contracted, and manufacturing growth also slowed down. Australia's economy was expanded faster than expected in the second quarter, as household spending and government spending outweighed a drop in export volumes. Though the data for Australia's labor market hasn't come out for August for now, but the market was pretty soft in July, Australia's labor market, primarily driven by a fall in the participation rate, which came out to be the lowest since 2008 because of the outbreak of Delta. It shuttered Sydney and saw hours falling and underemployment climbing. UK's economy swung back into growth in second quarter and avoided from contraction in first quarter as the economy opened up and consumers started spending heavily on restaurants and transportation, leaving the economy about 2.2% smaller than the pre-pandemic level, with the Bank of England forecasting the lost output from the new rise in infections would return by the end of 2021. India's economy did pretty well. GDP advanced about 20% year over year in second quarter. Japan's economy did pretty well, avoided a recession in second quarter, GDP expanding about annualized 1.3% quarter over quarter. German unemployment fell for a fourth month straight in August, declining by about 53,000, pushing the jobless rate by 10 basis points to 5.5%, the lowest since March 2020, though inflation concerns continue to weigh on the economy, with inflation jumping to its highest level since 2008 in August, with CPI rising 3.9% year over year, significantly faster than the 2% aim that ECB has set to achieve sustainability for the euro area, primarily due to higher energy costs and the higher costs passed on by businesses. Hong Kong raised its economic forecast for the year for 2021, with the city now projecting GDP growth of about 5.5 to 6.5% in the year, compared with earlier estimates of 3.5 to 5.5%. In terms of stock-specific news, I'll probably cover the stocks we hold in our portfolios. So Wisec Global, one of the stocks we hold in our portfolio, did pretty strong, was because of its results. It surged an intraday 28.5%, taking its 1 month performance to about 57%. After the company projected financial year 22 EBITDA of 260 to 285 million, which came in above the street estimates of 239 million. And the company declared a final dividend for 2020 for financial year 21 of 3.85 cents per share, which was about 140% higher than higher year over year. Nanosonics increased about 24 to 25% in the month, with sentiment boosted after the company upgraded its North American total addressable market size to 60,000 units from 40,000 units, and announced that it anticipates a return to double-digit growth in total revenue in financial year 22. Iron ore players took a hit, with Rio declining 16%, Fortescue declining 15.7%, and BHP declining 14.7% in the month, primarily due to declining iron ore prices, which fell about 14% over the month. Beach Energy declined about 12.5% in the month after reporting weak financial year 21 results, with full year NPAT falling 37% year over year, primarily impacted by 117 million of non-cash pre-tax impairment. And after the company disappointed with its financial year 22 guidance, with management announcing that it expects the production to be further impacted by declining Western Flank fields ahead of the ramp up of production in the Perth Basin and the Victorian Otway Basin development projects. That was the wrap up for the month. Any questions? I'm happy to take.
Thanks, Gaurav. If there's any other points or comments or questions, as what Gaurav said, we can take it online or after the meeting. I'm just conscious of time. The other thing that I wanted to note was a lot of the data and forecasts that Gaurav was referring to, we actually provided in this document, which is our charts in focus, an overview of global investment markets chart pack. This is published on a monthly basis, and it gives a lot of data on global equities, Australian equities, US, European, Asian equities, as well as forecasts on global economics, fixed income, commodities, and foreign exchange. So just to go in summary to what some of the things that Gaurav said is very much available in this document, and the forecasts for some of these macro indicators, the key macroeconomic indicators are also presented in this document. Just flicking through, we've got forecasts for the usual suspects across the G20 countries, so the 20 largest economies around the globe, in terms of real GDP, inflation, unemployment rate, current account as a percentage of GDP, the budget as a percentage of GDP, central bank rates across the G20 countries, 3-month rates, 2-year note yield, 10-year note, energy forecasts, agricultural prices, metal prices across, gold, silver, platinum, etc., etc. There's foreign exchange as well, and currency. So currency forecasts. So there's a lot of data there to go through, and I'm hoping that obviously Gaurav will make himself available if anybody has further questions.
Yep, Jai, very quick. I have a question for everyone. I was having this in my mind looking at the August monthly report. The market statistics shows that it has been higher since 2020. If you see for the month of August, it has been higher in August. Like, what was the major reason it was not high since January 2020? Since May, it has been started increasing, but why August has a peak in market statistics?
August is this is only my opinion. I think for a number of reasons.
Because of iron and ore, like just Gaurav was discussing about iron and ore. So regarding the mining industry, one thing I can know, but any other reason do we have?
Yeah, I just put a number of reasons. I just put up this this data that drills down in this chart. I'm hoping that everyone can see. But if you look at the breakdown of what performed well in the month of August, this is dated till the last week of August, so we really need to update this. But leading up to the last week of August, you can see that the sector that really performed really well was information technology. That was up 11%. The second, and my view of tech companies is a fewfold. The first point I would make is that you've got the interest rate that I'll come to and talk to in the next bit of our presentation. But the low interest rates that is going to be lower for longer is really going to push growth companies like those in the IT space. And the reason being is that capital is always finite, and capital management initiatives, considerations for the company is a fewfold. They can, of course, all about best return for shareholders. So how that is typically, one, is it going to be best in terms of a share buyback, or secondly, a dividend return to shareholders? Third, can they undertake growth projects? Sorry, there's a bit of stake. The third point is there a lot of projects that they can undertake that can deliver them the best growth, considering that they have now access to cheap capital? And I believe that the results that they reported were quite good in the month of August, so that people were quite comfortable with reinvesting into the tech space, when in the previous 6 months they were actually thinking that it might have been a bit of a bubble and taking some profits off the table. So I think that's the reason why they did really well in that month. The second space was healthcare. Probably
I think I might be wrong, but is it just for like Afterpay has been acquired or merged with US company Square Inc. That's why the IT percentage has been increased tremendously, like just based on one or two companies.
Absolutely, you're absolutely right on in that regard too. So a few points there. Afterpay was taken out, but with a good premium. WiseTech is the other company that Gaurav mentioned earlier. That was up, from my understanding,
about 57%.
Yes.
For the month.
So if you look, correct. Thanks, Gaurav. If you look at this chart of what stocks that did well, WiseTech and Afterpay is what is absolutely, you're absolutely right.
The highest percentage, yeah.
They did, so WiseTech did 57% and Afterpay did 39%. So that really drove the sector and drove the performance of that sector in the month of August. Some other ones that, to note was Domino's Pizza, 34%. So that did really well. And the results really reflected, the performance really reflected the strong results there. Nanosonics is another one. For me, that's a, medical device company, very techy at heart as well. And it really rebound off the back of hospitals reopening following higher vaccination rates in the US particularly. So yeah, you're absolutely right, Pooja. Some of these companies are just benefiting off a few names in their space. And funnily enough, when you look at the data, the charts, the material sector is one that you mentioned as well. Iron ore really languished, but it didn't decline as what people expected. It was pretty much flat for the month. But the thing to note is that you've got two things that are happening there. You've got on the one side, the company is doing really well off historical realized average realized prices that they achieved during 2020, and now they're paying off really good dividends and doing share buybacks and also paying out special dividends. On the flip side, there's been a expectation of moderating iron ore prices, which is somewhat starting to be more stable at the $170 levels, 170 US per ton levels. Hopefully it stays at that level. We suspect it will stay between 150 and 170. There's a lot of people saying that it will drop to 100, which we think that's a bit too early to say. But suffice it to say, it's interesting that people are valuing or valuing them for the future, and that's fair enough. Rather than giving them credit for what they've achieved in the past year, and the dividends that they're paying out. Probably the other one that's interesting is the energy space. There's a lot of talk about climate change and transitioning into more healthier fuels. And also Gaurav mentioned in the presentation that I believe, Gaurav, you said that there was a excess supply coming online, which
yes, by OPEC, about 400,000 barrels a day, starting 400,000 barrels starting August.
Hopefully that answers your question, Pooja.
Yep.
There's no other questions, and absolutely, we're happy to take questions now. We might move on. I'm just conscious of time, and we might leave a bit of time at the end as well. My part of the presentation is just an update on the Australian macro. So the Australian charts pack that we put out has a lot of data that goes around the globe. We look at it on a constant basis. Certainly, we update that on a monthly basis, and a lot of the work, is derived from that. But today I just wanted to focus on the Australian macro and, about what happened yesterday with regards to, that's a bit of, the next slide is just a bit about myself. Again, as to who in the call that don't know who I am, I've got about a 15 years experience in financial markets, qualified lawyer with Bachelor of Commerce and Bachelor of Laws with a graduate diploma. So I've been doing this for a while, but enough of me. Let's talk about what happened yesterday, and absolutely happy to fetch questions. But essentially, no surprises here. The Reserve Bank of Australia maintained their cash rate at 10 basis points, and the interest rate on the exchange settlement was kept at 0%. The other thing was that the second point that the second decision point that they did was that they maintained the target of 10 basis points for Australian government bonds. And then the third point that they made, again, no surprises. They're still continuing to buy government securities at a rate of about 4 billion to at least mid February, I believe. So one of the things that they said was that, the board is committed to maintaining highly supportive monetary conditions to achieve a return to full employment. So full employment, remember that's quite important, and inflation consistent with the target. Now, the next point, the next sentence is the next two sentences, what we've been focused on, and in terms of our forecasting and what the market's been relying on, is that it will not increase the cash rate until actual inflation is sustainably within the 2 to 3% target range. The central scenario for the economy is that this condition will not be met before 2024. So that's really important. Like those two sentences, if you take away anything from this presentation, is that they will maintain the cash rate at 10 basis points and they won't change anything until inflation is sustainably within 2 to 3% target range. And they don't expect that to happen before 2024. So that means that between now, well, this is closer towards the end of 2021 now, that's 2022, 2023. So that's another 2.5 years before they actually think that they'll make any changes. So I thought that's quite crucial. Obviously, we'll keep monitoring that for things that will change. Other interesting points that from this statement that they made was that was on GDP. So they said prior to the Delta outbreak, the Australian economy had considerable momentum. GDP had increased 0.7% in the June quarter and nearly over 10% for the year. Unemployment actually had fallen below 5%, and job vacancies were at a high level. But they said, of course there's because we've seen it in our everyday lives. The recovery in the Australian economy was interrupted by the Delta outbreak, which is very obvious. We see it. And obviously the associated restrictions affected activity. So now they're expecting that GDP to decline materially in the December quarter and unemployment rate to move higher over coming months. Again, no surprises there. We've seen what we've seen with New South Wales being the largest economy out of all the states in Australia being in lockdown. We expected that. Victoria also being locked down. We expected this. So there's nothing absolutely new with this. The interesting point there is that they're expecting that the Delta outbreak to be a delay, but not derail the economy, the recovery. And that's because of the vaccination rates that they expect to increase further. So, the third point is very interesting because what they're expecting is that there is a delay in the recovery, not a derail. If there's a derail, then that's going to be problematic for Australia as a whole. And that will, I suspect, shift investment managers who look after multi-asset funds, particularly strongly. Now, I just added house prices all the time because it's always a talking point around the barbecue. It really adds nothing to what the RBA is thinking about right now. But, you know, they're seeing that house prices are continuing to rise. Again, no surprises there. I guess the only surprise there is that, you know, everyone's in lockdown. So who's visiting these houses, and who's attending these auctions? It must be virtual visits and, you know, virtual auctions that's, you know, flipping that's.
I think the reason would be, Chai, that people are not allowed to go anywhere except for the property visit. So they are just, you know, finding out a way to visit the, you know, property location and just have a change, you know, rather than being in one house. So that can be a driving, you know, factor over here.
I'm gonna use that hack and try to go out by.
It works. It's actually good. You can try it. It works well.
I would do that because I just want to be out of the house, to be honest. So yeah, the last point there is that, you know, they said, given the environment of rising housing prices and low interest rates, the bank is monitoring trends in housing borrowing carefully, and it is important that lending standards are maintained, which is interesting, but it just goes to show, back to the first point, that house prices are forever increasing, but it's not part of the bank's thinking. It's actually never part of the bank's thinking. The two objectives is full employment and you know, controlling inflation. And so going back to this is that interest rates will be lower for longer. And if I had to say anything about housing, interest rates being low for longer means that provisions at banks do not need to be declared or bad and doubtful debts. And many people can, despite Corona affecting employment, people are still able to pay their loans. You know, they're able to service their loans quite comfortably. These are, the next slide is some of our forecasts, and just some points, some key points there. These are consensus forecasts, which we utilize and rely on quite aggressively. We look at it and monitor it very, very closely, particularly if there's a divergent forecast in contrast to what we're thinking. But by and large, so these consensus forecasts comes out of roughly 50 or so economists from leading investment banks and the big four domestic banks. And by and large, there's been really no outer consensus thinking at the moment. It's very in-line thinking amongst all the economists. But some key points there. Real GDP year on year is expected to decline from Q2 2021 at 9.6% to 4%. Now remember what the RBA said. They expected that there will be a decline in September. So again, very in line with what the RBA is saying. Then Q4 forecast is at 2.4%, and then you've got Q1 2022 is where the trough is before there's a rebound. So the rebound in GDP year-on-year numbers begins in Q2 next year, which is very much in line with what the commentary of the RBA is saying. The other point to be made is inflation. Now, again, they want inflation to be between 2 and 3%. Now, right now, it's at 3.8%. The consumer price index is as a reflection of inflation. They think it's right now, we recorded a 3.8% number. We're expecting 2.7%, and a decline gradually towards more that 2% number till Q4 2022. Unemployment is an interesting one. The data has been very much, I guess, manipulated as a result of policies by the government like Job Seeker and a lot of payments to small businesses to support continuous employees continuing their employment. Contrast that to the fact that we're in lockdown and, you know, services in restaurants and cafes, which is a bulk, represents a bulk of the workforce, being locked down, you question this 5.2% number that whether it's true or whether it should be higher, but manipulated by government policies that are supporting employment right now. So we'll see whether these numbers are actually quite accurate or not. But in terms of consensus, we're expecting it to be 5.2% in Q3 2021 and trending downwards to Q4 2022. But again, you know, the numbers are very manipulated. The central bank rates, again, very consistent with what the RBA says, 10 basis points till Q4 2022. And if I extended this forecast, it'll be the same. I don't, having a gut feel, and this is just, speaking with people and getting anecdotal evidence, speaking with economists, I have not seen anybody do an out of consensus forecast for the central bank rates. Likewise with the other rates, and if you look at the last indicator, the Australian dollar versus the US dollar, quite consistent there, appreciating a little bit by Q3 2022, but by and large quite stagnant, and that's fair to say. That's fair. Let me just show you again, like the data is very much, the forecasts are very much for the goes across for the G20 countries as well. So if you have a flick of these slides, there's a lot of forecasting for the other countries as well. So by all means, take your time and go. I recommend going through those numbers and giving us a call if you have any questions. But by and large, that really concludes our presentation. If there's any questions, happy to fetch it now.
Yeah. Hi, Chai, Bhavishwari here. So I have one question which has always, kept hovering my mind, because it's been now, extensive period that, RBA has been deciding to keep a cash rate of 0.1%. So I'm afraid to know that, how are banks dealing with 0.1%? Because ultimately inflation is, everything that if there is an increase in demand, if it is strong enough, that pushes up the prices and it leads to higher inflation. But when you have a interest rate of 0.1%, it can also lead to a negative cash rate. So how does the economy as a whole, Australian economy as a whole, deals with 0.1%? Because ultimately it's borrowing of money between the two parties.
That's an absolute great question, because what we've seen over the past 18 months has been a lot of fiscal stimulus, a lot of money being promised to support people in lockdown. So you're absolutely right. We're very, very worried, and there's a few points to that. On the economic side, the significant amount of fiscal stimulus needs to be paid for by somewhere, and that's been coming from the taxation of particularly the iron ore miners. And we've been quite worried about the iron ore miners who've seen their prices moderate. They've had fantastic, 2020 in terms of earnings, from higher iron ore prices, which have been, at $200 to $220 US per ton levels. And so they're well equipped to, they've made supernormal profits. And that's really shown in the results in August. The government's been taking the taxation there and really playing around with the budget to support these fiscal stimulus initiatives. On the other side, you've got also you've also got accommodative monetary policy, which, like we've been talking about, is expected to go to 2024. And so that, that's a lot of both fiscal and monetary policy stimulus. What we're worried about is more the longer term viability of this country not to be in recession. And we worry about it constantly for all the same reasons that other economists point out. And that's namely, one, what happens when China stops taking our iron ore? If they stop taking our iron ore, that means that our iron ore miners will stop earning supernormal profits. And that means that the taxation collected that support the fiscal deficit right now is going to be impacted. The second point that I'll make right now is that you're absolutely right. Like what I've said in my first point, the RBA is actually trying to maintain a target of 10 basis points for the April 2024 Australian government bond. And they're also purchasing government securities at a rate of 4 billion a week. And they're going to continue purchasing at this rate until at least mid-February 2022. So that's a lot of fiscal and monetary policy action that's taking place that we've never really seen before. Hopefully that answers your question, that we're quite fearful of what it means for GDP growth, particularly, because you're absolutely right. There's a lot of activity happening right now for what is very obvious. It's manipulated growth, which we don't see because everyone's still stuck at home in a lockdown. So the numbers are not quite there. We're not producing anything because we're in lockdown on the one side, but we're more focused upon, we're on a knife's edge because we're focused on collecting tax money from these iron ore producers. In terms of the banks, you mentioned also you're worried about the banks. We too are very worried about the banks because there's a few points that are happening there. Banks really can't firstly, they've come out of a really lengthy Royal Commission into the banking system, which really, for lack of a better word, focused on lending practices. So that's great. That's meant that provisions and loan loss as a percentage of total loans should be better managed. And it's been well managed by the banks for the past 10 years. Loan losses have been at a record low for a very long time. But having said that, the question for banks is, how do they make money when the interest rate is at 10 basis points? How can you keep lending and lending at a very low rate? Obviously, you're earning your net interest margin, but the history tells us, when we look at the likes of Deutsche Bank and the Germans and the Europeans, which have been in close to zero interest rate for a long time, and sometimes negative interest rate, that their banks struggle. Bring that back to a portfolio scenario where we're worried about iron ore miners and we're worried about banks. It's, you know, which are the two largest sectors in our economy, and where a lot of people have exposure. We're constantly worried because it feels like it's, you know, you're absolutely right. We're at a knife's edge. Where can we hide? And then when we try to hide in IT, we see that they're up 30 to 60% already. And we're worried about this bubble happening in terms of valuation. So let's just say that we're worried everywhere because yes, we've done well in managing Corona and our GDP. Yes, we've got 26 years of GDP growth, and yes, there's been, like, you know, been months and quarters where it appears that we're going into inflation, but we haven't really. And yes, there's been manipulated government, you know, government's initiatives which have affected the numbers. But yeah, there's a lot to be worried about. I rabble on, to be honest. I'm ranting. So I'll stop there.
Can I just add to that, Chai? I agree with you. I think, look, the bottom line is the banks, the central bank, which is the bank to the retail banks, is basically saying with a 10 basis point interest that it pays to the retail banks for having the reserves, we don't want you holding those above the minimum reserve. So you go out and put that money to work, or else it's not going to earn anything for you. So that's the indication to the retail banks from the Reserve Bank. But at the retail banking level, if you've just parked your cash in no interest, like the typical savings account, you're basically giving the retail bank money for nothing. They're paying you, I don't know, whatever they're paying at the moment, it's nothing pretty much. So if you've got inflation in the economy of even, or well, if we reach the Reserve Bank's target of 3%, the money is losing value at the rate of 3% in the next 3-4 years if we reach that mark, the rate, and you're getting a deposit rate of, you know, lucky 0.5%, because the official rates are held low artificially, you're losing value on your deposit. So that's why people, particularly in the retirement phase, or anyone who's got massive holding of cash in their accounts, are going, I need to put it to work. Otherwise, I will actually lose money through inflation. Albeit inflation is very low, it's just the cost of capital is so low that I'll just net lose money. So that's why there's a squeeze on going into property assets, anything that's got an income attached to it, going into, you know, hybrids and the like. But the other point about negative interest rates, I mean, you've only got to look at the risks that these banks put out every time they do a hybrid issue. You have a look at the capital notes issues that have come out in the risks section. They will talk about there's a risk of negative interest rates, and the banking system is not cut out for, you know, paying you the money for lending you the money, kind of thing, you know, on a mortgage, i.e. negative interest rates. So that's an issue on their margins going forward if we were to really hit the real negative interest rates. But on an inflationary basis, average person having, you know, no interest earning in their deposit account is losing money already. So that's just to add to Chai's commentary.
Hopefully that answers that question. Is there any more before we wrap up this presentation? Again, we're always available, you know, not just myself, but the team. It's always available to you guys outside of these presentations.
Thank you, Chai. I guess we don't have any. Bhavishwari or Pooja, do you have any other questions?
All good.
Okay, great. So thank you, Chai and Gaurav, for the presentation. And we had a good discussion today. So thank you so much. And thank you, Max, for your input. So thank you, everyone.
Thanks, guys.
Thanks, everybody.
Thank you, everyone.
Bye.
Keep safe.
Recording.